This conference will now be recorded.
The Budget'21 India, organized by the German Engineering Federation, VDMA, with Rödl Partner Consulting Private Limited. We hope all of you and your family and colleagues are safe and doing well. I am Jamli John, based out of the Mumbai office of VDMA, and I'll be taking you through the session. Before we continue, I'd like to remind all of you that for optimal viewing experience, kindly select the View Active Camera mode. Kindly turn off and mute your microphones, and you could continue to post your questions in the chat box. Do this during the entire session, and we'll take it up during the last leg of the web seminar. Next slide. VDMA is committed to India. VDMA, the Mechanical Engineering Industry Association, was founded in November 1892 and is the most important voice for the mechanical engineering industry. VDMA represents around 3,300, mostly medium-sized companies, making it the largest industry association in Europe. Its members contributing currently to 78% as exports, which is equivalent to 232 billion euro production. Recognizing the very early significance of India as a future market for the member companies, India was one of the first overseas offices among the BRIC countries. VDMA is the only German industrial association having well-established offices in India since several years. Their office is located presently in Noida, Kolkata, Mumbai, and Bangalore. Next slide. For today's web seminar, we will begin with a short address from Mr. Rajesh Nath, the Managing Director of VDMA India. We have amongst us Mr. Carl Erleding, the Deputy Consul General from the Bangalore Consulate, as our esteemed chief guest. He shall make the special address on the update of COVID-19 situation in Germany. This will be followed by the presentations from Rödl Partner on the latest changes in the legal and tax framework covering direct tax and international taxation, GST and customs, and transfer pricing. This will be followed with the Q&A. With no further delay, I'd like to hand it over to you, Mr. Nath. Mr. Nath, you are muted.
Good afternoon, members and friends from the industry. A hearty welcome to all of you at the Budget 2021 analysis session today, being organized by the German Engineering Federation, VDMA, along with our esteemed partners, Rödl Partner Consulting Private Limited. I extend a warm welcome to Mr. Carl Erleding, Deputy Consul General, German Consulate in Bangalore. Welcome, Carl. Also to Mr. Rahul Oza, partner and head of Pune and Mumbai offices of Rödl Partner. Our esteemed speakers today, Mr. Chetan Kakaria, Mr. Anand Khetan, and Mr. Sunil Vaidya. Friends, the Budget 2021-22, the first budget of this new decade, is, as they say in Latin, sui generis, that is unique, since it has been undertaken in circumstances like never before. Amidst a global economy already in pangs of a slowdown and being pushed in an unprecedented contraction, a fillip to the Indian economy through a growth-oriented and expansionary endeavor instead of a protectionist budget was the necessity of the hour. With people having navigated 2020 with considerable pain, there were expectations that the budget would help revive the economy. Unlike in normal times, when the concern is on deficit and debt, the focus this year is on how the budget helps in increasing aggregate demand, particularly by increasing investment expenditure, and more importantly, how it addresses several structural weaknesses which had reduced the growth potential. The two key features of this budget has been emphasis on infrastructure sector with an outlay of INR 5.54 lakh crores and the healthcare sector with an expenditure of 64,180 crores. This digital budget laid down the government's vision for Atmanirbhar Bharat, resting on 6 pillars: health and well-being, physical, financial capital and infrastructure, inclusive development for aspirational India, reinvigorating human capital, innovation and R&D, and what is important from the government point of view, minimum government and maximum governance. As expected, a pandemic recovery plan dominated a 37% increase in infrastructure spending and more than double expenditure on health and healthcare infrastructure were the most prominent features of the Union Budget 2021. Highlights for the industry included the aim Highlights for the industry included the aim to end the monopolies of the distribution companies and provide the consumers with a choice of a framework that will be put in place to give consumers alternatives to choose from amongst more than one distribution companies or discoms. Then there's the hydrogen energy mission in 21-22 will also be launched for generating hydrogen from green power sources. Further, to give a boost to non-conventional energy sector, additional capital infusion of 1,000 crores has been provided to Solar Energy Corporation of India and 1,500 crores to Indian Renewable Energy Development Agency, IREDA. Friends, the voluntary scrapping policy announced in the budget will for the first time bring fitness test as a criteria for scrapping old vehicles. Over 1 crore light, medium and heavy commercial vehicles with an age of more than 15 years have been plying on Indian roads. This policy will enable shifting of older to new vehicles, which will be safer and cleaner and reduce road accidents. The government has finally set the tone for recovery of auto sector, which has been significantly impacted by the pandemic. This will not only help boost the demand for production of commercial vehicles, but also support the entire transportation ecosystem. While it would have been good to see some more initiatives to promote electric vehicles in this budget, we are glad that the government has noted India's critical role in global automotive supply chain post-COVID-19. Specific initiatives through production-linked schemes, creation of infrastructure for R&D, and enabling skill development in new gen technologies such as artificial intelligence and machine learning will help drive investment in engineering and research. The Atmanirbhar Bharat PLI scheme, wherein the government has committed nearly rupees 1.97 lakh crores over 5 years, starting financial year 21-22, will be a game changer, especially since it will provide a major fillip to construction of industrial and manufacturing facilities, both greenfield and brownfield facilities. As the economic advisor mentioned, the budget is a combination of Pujara and Pant innings, consistency and flamboyance, steady focus on infra, commercial laws, ease of business with big shots of monetizing PSU assets, new disinvestments and insurance FDI. Friends, India won in Australia. Now India needs to rise fast from the slowdown in the new world order. Our experts today from Rödl Partner would dwell in the finer details of the budget and would give an analysis of the important announcements in the budget and its impact. However, before that, I would like to invite Mr. Karl Ehlerding from the German consulate in Bangalore for his special address on update on COVID situation in Germany. Let me briefly introduce Karl, friends. Mr. Ehlerding has been serving the Federal Republic of Germany as a diplomat since 2012. He pursued legal studies at the University of Hamburg, Germany. Mr. Ehlerding got his master's in international public and European law before joining the German consulate in Bangalore as Deputy Consul General in September. He served as the political counselor in Germany. Thank you.
So you want to go do as much as possible.
Sorry, Rajesh, I didn't hear the last. So Rajesh, do you hear me now?
Yes, now you can go ahead. Yeah.
Okay, I wasn't hearing the last words you were saying, but I assume you were giving the floor.
Excuse me, Mr. Mishra. Mishra from Wilcan, could you guys?
From the agent in Myanmar, the agents is open to the
Yes, Carl, go ahead, please. Sorry.
Thank you very much for this very warm welcome, Rajesh. It's always an honor, and I'm very happy to address the VDMA and its members, because the VDMA represents a very strong pillar of the Indo-German trade relations and the Indo-German relations in general. And of course, us as diplomats and as the German government, that makes us especially happy, because we see how important the relation between India and Germany in the future will be, and of course already is. So coming to the current situation in Germany, I would start with a little overview of how it developed. The coronavirus reached Germany in March last year, or it really started to make an impact. The first cases we had in January, but then in March it really got more in Germany. And the German government reacted by imposing corona measures, not a lockdown like in India. It was more that you couldn't meet more than a certain number of people. I was there myself at that time. I went to Germany for a week of holidays, and suddenly I was stranded. There were no more flights to India. I had done this 1 week of holidays, and then I had to stay for 3 months in Germany, which maybe was not the worst, because I know that the lockdown in India was a lot harsher than the one in Germany. And for most of you will know that spring in Germany is actually a nice time, so I wasn't too sad about it. And actually the lockdown in Germany worked. The cases were, the peak of the cases were 6,000 new infections per day in April. And then in May, June, due to the lockdown, they went down to about 100 cases a day. So it was quite successful. All the corona measures were lifted, and people enjoyed the summer in Germany. Unfortunately, they were actually forgetting about corona and weren't taking enough precautionary measures. They were traveling around Europe, traveling in Germany, gathering together, and of course the result was that that corona came back. A second wave slowly started, and in October it got more and more severe. And the peak was reached in December with around 30,000 daily cases, so much more than we had before in spring. And short before Christmas, a second lockdown was imposed, actually a very harsh lockdown. All schools are closed in Germany, and that's in Germany. This is considered the harshest measure, to close the schools, because in Germany it's considered to be very important that schools are open for the kids, and education, investment in education for the future. All the non-essential shops are closed. You're not allowed to meet more than one other person from another household. And yeah, these measures are in place till then. At the same time, at the end of the year, I think on the 27th of December, the vaccine campaign began in Germany. Unfortunately, it wasn't as impact making as it was hoped, because there were a lot of difficulties in delivering the vaccine. There was a lot of vaccine delivered to UK, US, and Israel, but Germany didn't seem to get, or Europe in general, because all the vaccine orders were made by the European Union. And somehow these vaccine producers didn't seem to have taken the European Union serious enough, so they were cutting on the European deliveries, but not on the deliveries of UK and US and Israel. So then the European Union was enforcing a lot of pressure, especially the president of the Commission of the European Union, the German von der Leyen. And now it actually looks good that more vaccines will be delivered. We're expecting deliveries of 80 million doses to Germany in the first quarter of the year. And the second quarter, they are expecting 70 million vaccine doses to be delivered. There is a certain order in which the vaccines are going on. So the highest priority group, which is vaccinated at the moment, the people above 80, which Germany actually has quite a few, because it's an old country in comparison to India. The average age in Germany is 46, where I think in India it's something about 28, 26. So these people are vaccinated, and healthcare workers are vaccinated, and all the people in old people's home, even if they are below the age of 80. The next group would be people above 70 and a few others, and then the people in the third priority group, the people above 60. So with that lockdown in place now, the numbers actually went down again quite significantly. We are having around 6,000 cases daily now in Germany. And but still, what we are measuring is the cases per 100,000 inhabitants in the last 7 days. At the peak, that was 200. Now we are at 80. But what the government wants is to bring these cases down to 50, because only when the number of cases per 100,000 inhabitants in 7 days are down to 50, then the authorities are able to track down where the infection comes from, and to inform people and to impose quarantines. If it exceeds 50, this is not possible anymore. They just don't have the manpower. So the aim is to get below this, and at the moment it looks very good. The lockdown will go on for another 10 days until the 14th. And then there will be the decision if it will be extended, if some of the measures will be relaxed. And as I see it now, there will probably be some measures be relaxed, and even on the time after, I'm pretty positive, because the reason for the lockdown in Germany is not so much to stop the pandemic. The reason is to save the vulnerable people, to make sure the ICUs are not getting to their limit, and to bring the number of people who die down. And recently it was around 1,000 people dying every day in Germany from corona. So once this group is vaccinated, the above 80-year-olds, and that is the most vulnerable group in Germany, and the people with comorbidities, I'm sure the situation in the ICUs will relax, and also the number of the mortality number will go down. And then the reason for all this harsh lockdown is not there anymore. I'm sure they will continue with some kind of measures, like India is doing it well, like you have to wear masks in public. But I think if it comes to all the schools and especially businesses, it will relax soon. I'm not sure if it will already happen in 10 days on the 14th. But I'm pretty sure end of February, end of March, it will look a lot different in Germany. Also because then even more people are vaccinated, and also more people had corona. So this will lead to some kind of herd immunity, not to complete herd immunity, but it will start to develop. And looking at the economic situation in Germany at the moment, we had a recession in 2020, and the fact that we had a lockdown now for the first, or we will have a lockdown for the first 6 weeks in of 2021 will probably hit the economy pretty hard in 2021 too. But the stimulus package of the government is doing its job. There is a lot of money in 2020. All the money that was there wasn't even requested by businesses, so there was more money than needed to support businesses. The problem is that it's sometimes not fast enough, that the administration is just overwhelmed by all the money requested, but the money is there. There is enough money. So I think this will do very good to the economy. And I also think once the pandemic is over, there will be a very good recovery, and numbers will go up significantly. Okay, I think I haven't exceeded my time limit. I don't know if that format is, if questions are foreseen in this format, but I'm very happy to answer questions or to engage in any kind of conversation and discussion. Thank you very much for your attention, and thank you very much for having me at this event, Rajesh.
Yeah, thank you, Karl, for your address and giving us an update on the scenario in Germany. The questions we take in the end, Karl. At the end of the session, we take the questions. Thank you. Yeah, I hand it over to Jim-Lee now.
Yeah, thank you, Mr. Ellerding and Mr. Nath, for your kind address. We would now like to invite our esteemed speakers from Rödl Partner to share their expertise and the highlights and the key takeaways from the budget. Next slide. So we have amongst us Mr. Chetan Kakaria, who's the head of direct and international tax from the Pune and Mumbai office. Mr. Anand Ketan, who's the partner and head of indirect tax. Mr. Sunil Vaidya, who's the partner at Sastakar Vaidya and Company. And Mr. Rahul Oza, who's the partner and head of Pune and Mumbai office for Rödl Partner. Thank you all for your patience, and over to you, Chetan. Thank you.
Thanks, Jamli, for that introduction. And the slides, I think the slide is not moving.
Mr. Manoj, can you switch on to these slides, please? Hello, Mr. Manoj? Yeah.
Yeah, now it is.
The moment we see green, we are happy.
Okay. So a warm welcome to all participants, and we'll start with the presentation. So next slide, please. Yes, so what we have done is we have first captured the highlights of budget, some key highlights, and then we will move on to direct and indirect tax and transfer pricing proposals. Can we move on to the next slide? Yeah, next slide, please. Yes. So this was one of its kind, the budget, as Mr. Nath mentioned in his welcome address. This was a situation which was never seen before, and as everybody of us can correlate how the situation moved from January to March to May and to the subsequent part of the year. Really, the situation started with a very small kind of seriousness about the entire COVID situation, and how India moved on to lockdown, how the packages came out. The lockdown was finally lifted after a long period of 4 to 5 months. And then the peak was reached in September. So till that time, there was a lot of uncertainty in the minds of people, businesses, how it is going to kind of close or end. But now, as we see post-September, the cases have consistently gone down. There has been a vaccine that has come out, and the vaccination has actually started. So I think year 2021 has started with on positive note that we can see, and something similar was the expectation from budget also, so which we'll cover in subsequent slides. As you can see at the bottom of slides, the Atmanirbhar package, which was announced in multiple phases, actually concentrated on MSME and industry, the medium and small scale enterprises, the agriculture and related sectors, the energy sector, particularly liquidity support, etc., and what the issues of migrant workers, because a lot of people had to migrate to their hometowns. So how to kind of take care of such unemployed people. So that's how I think the packages were structured and tried to give the boost to the economy. We move on to the next slide. Yes. So if we can see, like we saw, like what were the issues, how the issues came up, and what was the kind of India's answer to it. But if you also see how the budget is trying to solve some of the things on kind of financial sector, because that is one of the crucial sectors. So we see that, but I think there are a lot of measures we can see on the slide, like the GIFT City is there, the International Financial Center. So in each budget, there is some or the other boost that is given to the businesses in IFSC. There is a kind of some measures for securities market to have a single code rather than having multiple different codes and creating some bit of confusion. The permanent institutional framework for corporate bond market. Then for warehousing development and regulatory authority, so that is also on the cards. The investor charter to increase more confidence by having some investor protection measures. The privatization of insurance sector by increasing the FDI limit, and asset reconstruction and related measures to resolve the problems of stressed assets of public sector banks. So these are the things on card. So we see that these are primarily grouped under privatization, as well as the safer and more regulated markets. So I think these kind of measures are bound to give some kind of financial lift for India, which should even help other sectors to grow. So with this, we move on to the next slide. Yes. So other than financial sector, as all of us know, health, infrastructure, and pollution control. So these were some of the sectors which were, I think, under focus. Particularly health sector with all this pandemic has really kind of got a significant boost. And even in budget for COVID vaccine, there is a provision of INR 350 billion, which is a massive sum. Then there is a PM Atmanirbhar Swasth Bharat Yojana, so which has an outlay of double the COVID, the sanction for COVID. So it's around INR 642 billion over the next 6 years, and there are various measures that are planned. Same way, there are on infrastructure side, there are for water related measures which are there for urban local bodies. There is a cleanliness drive which is under Swachh Bharat mission. So if you can see all these to tackle the air pollution, vehicle scrapping policy. So those kind of measures are there to boost the infrastructure sector here. And apart from that, if you see parallelly on the right side, there are production-linked incentive programs which are there for various sectors like auto sector or the chemical battery sector. So those kind of there are total 13 sectors which are identified for which there is a kind of significant provision made for next 5 years. Same way, there is for textile, there is a Mitra scheme that is introduced. National Rail Plan is there to take care of traffic requirements up to 2050, plus significant increase in the freight corridor. And even for recycling of ships, there is a policy. So with all these measures, I think this sector should really get a boom. So without taking much of time, we'll now move on to the direct tax proposals. We can move to the next slide. So one thing which was kind of a cause of concern for everybody, would there be increase in tax? Will it be a new tax? Will it be a tinkering of rates? Will it be a cess? So a lot of questions were there, and as we all know, for individuals as well as corporate taxpayers, there is no change in tax rate. So I think first time people would have got sigh of relief by having no change in tax rates. Otherwise, generally there is the expectation that the tax rate should go down, but at least this time, even no change should have been a kind of great relief for people. So might we will spend 5 seconds on the slide just to see how the rates are moving. Largely, it is in the range of 25 to 30% for corporates. But if you go for the optional tax regime, then it can go down as much as 17% also in some specific cases, like new manufacturing companies. And foreign companies, there is a tax rate in the range of around 40%. So for individuals partnerships also, again, the rates have not changed, so we are not captured in the slide. We move on to the next slide. Yes. So I think every year there is a tradition that some or the other case laws that get reversed when the budget is announced, and really all professionals need to kind of put their heads together and see which case laws have been now reversed, now which favorable positions taxpayers cannot take. So this slide really captures some of the critical changes. So one is depreciation on goodwill. So anybody who acquires a new business, it may be a slump sale, it may be a merger acquisition. So in those cases, if you are paying a higher consideration than what assets you are getting, then typically that may be an intangible asset. So there may be goodwill, there may be customer contracts, there may be the skillful workforce. So all those things could be there. And there was a Supreme Court judgment which had allowed depreciation on such goodwill. And after that, there were plethora of judgments which had actually ruled in favor of taxpayers. Now that is sought to be negated, and now there will be no depreciation available on goodwill. Of course, they have to prescribe the method, how the what will happen for the past years, like how the capital gains will be calculated in case there is any past acquired goodwill, and how the written down value will be calculated in such cases. What could be the cost of acquisition, because you already claimed some goodwill and you have got some unamortized balance in your tax schedule. So that is there. In books, there will be still no change, and you will continue to depreciate it the way you are doing. It is more a change for corporate tax. Then next amendment is regarding employee contribution to provident fund. So as we all know that the employee contribution is deducted from salary and paid to the government by a due date. Now the controversy was really about what happens in case I am not paying by that due date, but I am paying before the due date of my return of income. So there were case laws which had come and given a positive view. Of course, there were some negative case laws also, but I think positive case laws were more on that issue. And generally, these kind of contributions were being allowed even at officer level in some cases, though not all. And there was still litigation happening. So now this controversy is set to is set to be put to rest, and now this deduction will not be available. So in case you miss the deadline to deposit employee contribution to provident fund, then it will not be allowed as deductible, even if you deposit it later. So this does not apply to employer contribution; it only applies to employees contribution. And the reason is that employees contribution is something which is not your income, but you are taking it and then you are depositing it late. So you are utilizing that money for some other purposes. And it may happen that if the company does not have financial capacity to deposit it in future, then employee loses his own income because of this. And that's why this provision is there. So with this, we move on to the next slide. Then there are some changes regarding dissolution or reconstitution of firm. So this may not be very relevant for corporates, but just to quickly explain it. Basically, when a partnership firm, or there are some other specified entities like body of individuals or association of persons, which of course may not be really seen very frequently in corporate world. For those kind of entities, when there is any kind of reconstitution happening or there is any kind of dissolution happening, then how the capital gain should get calculated that those provisions have been now brought in to make it more explicit, so that nothing misses from the tax net. So that's the idea. So in case any asset is passed on to the partner, then fair market value of that will be regarded as consideration, and any amount lying in his capital account will be regarded as cost of acquisition. Of course, the provision will not be that simple. There will be some more guidelines that will be prescribed, and there may be some different situation where this may work a bit differently. But that is the idea, to capture the capital gain and tax it, of course, in the hands of partnership or the specified entity rather than the partner. So that is this provision above, which, of course, as I mentioned, may not be very relevant for corporates. Then the next change was regarding slump sale. So as you would know, like if a business has to be acquired, then there can be multiple ways of doing it. You can buy it in an itemized manner, that okay, these are the assets of business, plant and machinery, office furniture, electronic equipments. So those you will acquire and you will use in your own business. Or you can acquire entire business as a division and continue to do the business from that particular facility. So that will be called as a slump sale. And there could be otherwise merger or acquisition or share deal that can happen. So those are different things. So in case of slump sale, the way the word sale appears, generally the courts had, some of the courts had interpreted that this has to be a sale for a consideration which is monetary. So in case there is an exchange, that there is a no monetary consideration involved, but other party is giving some other asset or some other kind of security for that, then in those cases it will be regarded as slump exchange and should not trigger slump sale provisions. So this was a way to overcome the slump sale taxation, which is now sought to be plugged. And now they said that instead of sale, in the sale we'll say that all types of transfer, which may include sale, exchange, relinquishment or extinguishment, all these things will be covered under slump sale. So this has widened the scope of slump sale. With this, we move on to the next slide. Yes. So tax incentives for affordable housing. Again, this is more relevant for the companies which may be into real estate sector and who are into affordable housing projects. For them, like there is a 100% deduction of the profits from the eligible projects. So for them, the time limit for getting the approval for project was up to 31st March 2021, which has been increased by 1 year to 31st March 2022. And also they have introduced a new concept of development and building of rental housing project. So not even affordable, but even rental housing projects also would have such kind of benefit. Only thing is that the detailed scheme for this will be prescribed in the due course. Then the next amendment was regarding startups. So for startups, the 100% deduction is available from the profits for 3 consecutive years out of 10 years. And this again, the condition was that it should be incorporated on or before 1st April 2021. Now, because of pandemic, I think again 1 year extension has been given and the period has been moved to before 1st April 2022. So the startup needs to be incorporated before that. And another provision is regarding exemption. So in case somebody is putting up a startup entity and he's selling his own residential property for that, getting capital gains out of it, which are utilized in the equity investment in the startup, then even that that capital gains what arises on such residential property was exempt. So this again was available up to 31st March 2021. So again here again 1 year extension has been provided for such cases. With this we move on to the next slide, please. Yes, increase in safe harbor. So now, many of us know that in case of real estate or house property, when anybody buys it, generally it may happen that the property value may be different and the stamp duty value may be different. And in case property value is higher than stamp duty value, then that's fine. But in case property value is lower than stamp duty value, then there could be a apprehension by tax department that such kind of lower value is artificial, and taxpayer actually would have got some consideration without banking channel, because of which there should be a taxation on the at least stamp duty value, if not more than that. So that is how the provisions were there. Then looking at the kind of harsh provisions, there was some leeway introduced that okay, up to 5% it should be allowed a variation. So if your standard value is 100, you are selling up to 95, that should be okay. Your 100, in such case 100 will not be considered as consideration, but only 95 will be considered. Now that was 5% was increased to 10%. And now because of COVID, there is a situation that even 10% may not be sufficient because the stamp duty rates have not changed, but the property values may have gone down and builders would have got a lot of inventory. So to overcome such situation, for some specific cases, they have increased 20% leeway. Again, this is where the builder is selling the property first time. So it is for first time allotment of the residential unit to any person. The value should be less than INR 20 million. And the period is between 12 November 20 to 30 June 21. So these are some of the conditions. If those are satisfied, then the 20% variation is possible. So in case 100 is the stamp duty value, the sale is happening at 80, still there should be no adverse tax implication for builder or for the buyer. Now, the important point is that this is only for allotment from builder to buyer. So in case if there is a resale of property, then really these provisions will not help. So really the benefit is given only to the properties that are sold by builders, not for the resale market. Then moving on to the next slide. Some of the other key corporate tax proposals in summary. So one is relaxation for interest on advance tax for dividend received. So earlier we know that dividend was subject to dividend distribution tax, and which was paid by the company who was declaring dividend. Last year, the provision was introduced to withhold taxes on such dividends, but that withholding may not be sufficient to take care of tax liability of the person who is earning dividend income, because the higher HNI category people may have much higher tax liability exceeding 30% on such income, and they were supposed to pay advance tax on it. Now you cannot predict when and how much dividend will be declared. So to take care of the same, there was a kind of a request to provide that the advance tax will be payable once dividend is received or declared. And so if the dividend is declared or paid in third quarter, then for first 2 quarters there should be no advance tax liability, and accordingly interest on advance tax should not apply. So this is to take care of such interest element. Then the next provision is regarding attachment of property in case of fake invoices. So in case of some firms which are doing some fake invoicing, etc., we keep on looking at some news articles, particularly from GST perspective, where such instances come to the light. So in those cases, it has been provided that there could be a power to provisionally attach the property in case penalty is likely to exceed 2 million. The other amendment is regarding the presumptive taxation for professionals. So typically, professionals having income up to INR 5 million were able to offer it to tax at a rate of 50%, considering that there is a profit of 50%, and then they were not required to maintain the books of accounts. So that kind of benefit is available to individuals or partnership firms, but not to LLPs. So that has been clarified. Then there is a definition of zero coupon bonds has been changed, again, which may not be very relevant in the group. Or exemption has been provided for TDS payments on dividends to a business trust, which is basically an intermediary. And business trust basically would have invested in a special purpose vehicle and would pass on those returns that are received from special purpose vehicle to the investors. And that's why to avoid the 2 level of taxation, business trust and the investors, the dividend income that is received by business trust is kept out of TDS net. With this, we move on to the next slide, please. Yes, on equalization levy. So many of you would know last year there was a lot of hue and cry when the provisions were introduced and expanded, and it was felt that there is a lot of clarity required on various provisions. Unfortunately, there was no clarity provided. Rather, there was a statement had come that there is no clarity required. The provisions are self-explanatory. Now, this year there has been some clarification provided. So, what happened is that the way the equalization levy was expanded, so it applied to online sale of goods and online provision of services. Now, some of these things can fall under royalty category or on the category of fees for technical services, which are taxable at 10%. So there is a section 10, subsection 50, which are provided that this is exempt from tax in case you are liable to equalization levy. So what would have effectively happened is that you would have saved 10% tax under 1050 if you would have paid 2% equalization levy in case you are supposed to pay equalization levy. Now, so looking at that was not the intention. So they have clarified that this kind of category of income will be excluded from the purview of equalization levy. And they will continue to be taxed as royalty and FTS. So that is one change. Second is they have clarified what is meant by online sale of goods, online provision of services. So it is clarified in a more expansive manner. And so on case-to-case basis, these things will have to be looked at, like whether there is an online acceptance of offer for sale, is there online placing of order, online acceptance of purchase order, online payment of consideration, online supply of goods. So all these things, even if one of the things is happening, there could be a trigger of equalization levy. So that's why this thing will have be required to be looked at on a case-to-case basis, looking at the entire supply chain model of the company. We move on to the next slide. So, yeah. There is a change of advanced ruling board. So earlier advanced rulings, advanced rulings could be obtained for taxation of non-residents. Now it is proposed to change to board for advanced ruling, which will be now constituted by departmental authorities of the rank chief commissioner. So earlier it was some retired judges which were part of the body. Now there will be departmental officers, and probably with that there could be some element of doubt about whether kind of rulings that come out, whether they will be taking care of assessees' concerns or not. Then next is the change in definition of liable to tax. So under the tax treaties, the term liable to tax has been defined, has not been defined rather, and now it has been sought to be defined under the Income Tax Act to say that in case any person is liable to tax under the law of a respective country, but is eligible for exemption, then also he will be entitled to treaty benefits. So in case any person is not covered as a taxable unit under any particular country, then probably he may still remain out of the treaty purview. And there was, of course, some dispute on this kind of issue in past, particularly in Gulf countries cases where people were from Gulf countries. So there probably this will become relevant. Then there was a change for FIIs, again not much relevant, but they have said that TDS can happen at the rate specified under Act or rate as per double tax avoidance agreement, whichever is beneficial. Next slide, please. Yes, on book profit. So there is a change that advanced pricing agreement or secondary adjustment. In those cases, what may happen is that the taxpayer's past year's income may change and they may get accounted in the current year. So tax officer has been provided power to revisit the calculations for prior years and accordingly adjust the tax liability of taxpayer considering the profits over a period of years for which they pertain. So taxpayer can file an application for that. Next one is regarding dividend income. Again, dividend income for foreign companies are taxable at lower rate compared to MAT, and hence it is provided that dividend income and corresponding expense can be excluded from MAT computation so that they are not subjected to a higher tax as per MAT provisions. Next slide, please. There have been changes in due dates for filing of return. So we move on to the next slide. There we are given a table where we can have a quick snapshot of the changes. So various dates have changed, and like particularly the last two columns have changed: due date for belated return and due date for revised return. The original return continues to be same. So if you see now, the date, the gap for the first two instances, the gap between the first column and second or third column is very minimal. So like you file the original return on 31st October, you can revise it only up to 31st December. Or you file a original return in 30th November, you can revise only up to 31st December. So those kind of time gaps have reduced drastically, and there may not be a meaningful time gap between original return and revised return. We move on to the next slide, please. There is a change in assessment time limit also. accordingly. So we move on to the next slide where we have given a table in a simplistic manner. So here, if you look at, we have plotted various assessment years, and if you look at the last two columns, how the assessment proceedings are going to get completed. So for say for AY 1819 and AY 1920, if you look at the last column, it is 31st March 2021. There was an extension of time because of COVID for AY 1819. But after that, if you see the last row, AY 2122, the time for completion will be 31st December 2022, which means that if you file a return, say by 31st October 2021 or 30th November 2021, the assessment will be completed by 30th December 2022, which is around a little more than a year. So which is a very short time frame, because a lot of times there used to be, so if you see, like compare with the earlier period where there used to be 3 to 4 years time, now that has drastically reduced, and like less than 15 months the assessment should get over. And if you also look at the second last column, there the last row, 30th June 2022 is the date for issuance of notice. So even the time limit for issue of notice has also been significantly curtailed. We move on to the next slide. So now here the last this is transfer pricing cases where there is a transfer pricing reference. Then if you see the last column, the time limit has increased by 1 year, because since there is a transfer pricing reference, so there will be an increase in time limit by 1 year. So we move on to the next slide. Yes. So these are procedural aspects on reassessment. So reopening, the time limit has reduced to 3 years, but in some cases involving more than 5 million of concealed income, it can be reopened up to 10 years. And there have been certain cases like if there is audit objection by controller and audit general, or there is some risk management strategy as per department. In those cases also there can be reassessment that may happen. Earlier, there were cases which used to hold that in such cases, unless the tax officer applies a fine, there will be no reassessment. And of course, there is a kind of relaxation provided that SSC can formally file a reply as to why the reassessment should not happen, and the assessing officer will have to first dispose of that application before deciding whether to reopen the case or not. We move on to the next slide, please. Yes. So there is a dispute resolution committee also, which has been proposed to be formed, but this is for very small taxpayers, like having INR 5 million of income and INR 1 million of tax dispute. So may not be applicable to many cases. So we move on to the next slide. So there has been an increase in threshold. So we know that there is a thrust on digital transactions. So now last year, if there are more than 95% digital transactions, then the tax audit applicability was increased to 50 million of turnover, which has been now increased to 100 million of turnover. So if you are having entire more than 95% digital transactions, then this will help you. Then there are provisions for faceless ITAT proceedings, and income tax settlement commission is sought to be discontinued. So which is more for settling the cases of dispute which are there. We move on to the next slide. Then TDS on purchase of goods is sought to be introduced on similar lines as TCS on sale of goods that was introduced last year. So so this is just a kind of flip side of it, and will apply similar thresholds are there, more than 100 million of turnover and more than 5 million of purchases in a year. So then TCS has to be done, TDS has to be done at 0.1%. In case there is no PAN, then it will apply at 5%. Next slide, please. Then in case of non-filers, there will be higher rates of TDS and TCS. And if the returns are not filed for 2 financial years, prior financial years, and the time limit has expired, then these provisions will apply. Some of the provisions have been excluded, like TDS on salary, TDS on banking transactions, and some other provisions. And if the TDS or TCS liability is not more than 50,000, then also these provisions will not apply. Next slide, please. On individual taxation side, there has been a LTC, leave travel concession benefit available. So this year it has been expanded to, only for this year, it has been expanded to any other expenditure where GST of 12% or more is applicable. and then 1/3 of the expenditure incurred is allowed as exemption up to a limit of 36,000 per family member. So this is the condition is that the payments should be made through banking channels. So there are detailed rules that will be provided for this. We move on to the next slide, please.
10 slides ago, you said 3 slides.
Yes. Then interest on employees' contribution to provident fund, that will be now taxable in case the contribution in a year exceeds INR 250,000, and this provision will apply from next year. Same way for withdrawal from unit-linked insurance policy. If any new policy is taken and the premium is more than INR 250,000, similar taxation will apply under capital gains. Yeah. Next slide, please. So there has been a relaxation for senior citizens from filing income tax return, and there is also some relief provided to people who are deputed to overseas and then return to India regarding the taxation of retirement fund balance. We move on to the next slide. Next slide, please. Yeah. The same way, affordable housing related amendment we discussed, similar extension is provided for the individuals who will have tax liability. So they will have 1 more year to claim such benefit. Yes. Next slide, please. So with this we come to the end of direct tax proposals, and I hand over to Anand for indirect tax proposals.
Anand, mute yourself, please. Unmute yourself.
Anand, unmute.
Sorry. Good. Thank you, Chetan, for this extensive summary on the direct tax proposals. Now I will quickly, take you through some important changes under the indirect taxes. See, after introduction of GST, the budget has sort of become a non-event from an indirect tax perspective, and the number of changes are sort of, getting reduced every year, like the duration of the finance minister's speech. However, still, some important agenda is picked up every year. And this year, it seems to be more on the overhauling of the exemptions under the customs law. However, before we, take a look at the changes under the customs, let's take a, look at some of the important changes under the GST regulations. Next slide, please. Yes. So here, basically, we have just tried to give you a small comparison as to, what were the revenues under GST. And, it will just basically show you a small picture as to that the collections under GST have been increased significantly after a lifting up of the lockdown. And the last 2 months, it has been really, a record-breaking performance from a government collection perspective. And accordingly, this year's budgets have been drawn keeping in mind the collections. Then moving on to some important changes which have been brought under the GST law as such. First is, the definition of the term supply under Section 7 has been changed retrospectively. So every year they bring at least 3 or 4 retrospective changes, signaling that, the law originally was not drafted very accurately. But here, this basically this change was brought to, overcome the Calcutta Club Supreme Court judgment, where it was held that services and goods supplied by a club to its members is, services provided to self, and therefore it should not be liable to service tax. And similar analogy was being drawn under the GST regulations. So now they have said that any transaction for a consideration between any person other than individuals with its members would be deemed supply under Section 7. So all transactions between clubs and its members would now be taxable retrospectively from 1st July 2017. And more likely than not, people who have not paid taxes would have to also pay interest on the same. Second very important change is that, the provisions relating to GST audit have been done away with. This was sort of a surprising change for a few tax professionals, I would say, but not for the industry as such, because during the last GST Council meeting, there was a lot of negative feedback about the whole process of GST audit, where it was deemed to be very costly affair for MSMEs, and also the forms and the compliance process was deemed to be too extensive for the MSMEs and especially other companies. And therefore, it has been proposed that this entire process of undertaking GST audit by chartered accountants and cost accountants would now be done away with. and only a self-certification would be required to be filed by all the companies. Further, it has also been planned that the commissioner may bring by a notification and exempt certain categories of companies, and they would not be required to file this self-certification also. So this would significantly reduce the annual compliances for all assessees. Third change was on bringing another condition for availment of input tax credit. Up till now, we all know that there was a rule 36(4) which provided that you can take input tax credit on your purchases only when up to 105% of the invoices which are getting reflected in your GSTR 2A and 2B. There were a lot of cases in the high courts which are pending, which said that there is no legislative backing to this rule 36(4), and it is an arbitrary law which cannot be enforced by the tax department. So now they have brought this change under section 16(2) of the CGST Act, and now it is mandatory for a person to take a credit only when the supplier has filed his form GSTR 1, which is the outward supplies, and the same invoice is reflecting in your GSTR 2A or 2B. The next change is on the recovery proceedings. There were a lot of notices which were issued on account of mismatch between GSTR 1 and GSTR 3B, and there were doubts whether GSTR 3B as such is a return or not, and therefore now they have made an express provision to say that if there is a deviation between the output liability declared in GSTR 1 and when you compare it with the outward liability and tax paid on GSTR 3B, the department can automatically initiate recovery proceedings on such suppliers. So very important change which requires every company to keep a reconciliation not on only on your purchase side but also on the sales which are reflected in the two forms. Next slide, please. Yeah, very important change for all exporters, which I would like to specifically highlight here. There was a small change. Some people are calling it a small change, that the definition of zero rated supply under section 16 of IGST Act now has been changed to just clarify that the supplies made by normal suppliers to SEZ units would qualify as a zero rating only if they are used for authorized operations. Now, this term used for authorized operations used to exist in the pre-GST era, where under VAT you had a specific form called as Form H, and then in service tax you had a specific form called as Form A1, A2, which was used to sort of affirm that the goods are being used by the SEZ units for their authorized operations. Now, under GST there is no such form or no such procedure prescribed, but they have now introduced this this language change that a supply by a normal unit to an SEZ unit would qualify as a zero rated supply only if the supplies are used for authorized operations. Now, you as a supplier supplying to SEZ unit needs to ensure that the goods and services are being used by the SEZ for its authorized operations. Else, you cannot claim it as a zero rated supply. So the onus has been shifted now to you as a supplier, and it is suggested that all suppliers take suitable declarations and indemnities from the SEZ customers so as to mitigate their future tax liability, if any. So this is just a word of caution here. And also a change on the refund side. Earlier you had two options of claiming GST refund. One was on payment of GST and second was on unutilized input tax credit. So the option of payment of GST and claiming a refund has been discontinued, and now you can only claim a refund of unutilized input tax credit. And at the same time, it has also been made mandatory for you to realize your export proceeds within 9 months. Currently it is 15 months due to COVID, but normally it is 9 months for you to realize your export proceeds for goods. So if you're an exporter claiming a refund, you need to ensure that the goods are the consideration is received by you within 9 months. Next slide, please. Yeah, this is some changes on the the seizure, detention, and release of goods in transit. So a lot of cases have been going on where they have detained and seized the goods which are in transit, and they have made a lot of changes to say that these proceedings would be treated as separate proceedings as compared to recovery of tax. Also, you have to pay at least 25% penalty if you want to go to appeal. The penalty provisions equivalent to 200% have also been introduced. So host of changes have been made on account of detention, seizure, and release of goods which are in transit. Next slide. Here in the next slide, now we move on to basically the customs related provisions. First is, the changes to the first schedule of customs tariff are proposed that will come into effect from 1st January 2022, which is in accordance with the HSN 2022, which is the 7th edition of the HSN used for uniform classification of goods traded internationally. So India, being a member of WTO, has to follow the continuous changes into the HSN nomenclature system. And these changes are necessary to sort of adapt to the current trade through recognition of new product streams. For example, they have now added a new tariff classification for factory robots. And then because of the nature of changing in the nature of commodities that are being traded, so these tariff changes are required to be made. So a total of about 350 amendments have been brought to HSN tariff, which we cannot discuss obviously here. So you have to basically go back and see the HSN classification that you are using currently and whether there is any change in the said classification system under the new tariff system. Next slide is on, or the next point is on the exemptions. It has been now provided very importantly that now all customs exemptions which would be conditional in nature would be applicable only for a period of 2 months, rather 2 years, which is, the sunset date would be 31st March of the year after 2 years of introduction of such exemption notifications. And all the current exemption notifications would also be over by 31st March 2023, which is the sunset clause. And the government also mentioned that they are reviewing almost 400 customs exemptions, and the new customs duty structure will be brought by 1st October 2021. So this is a very, very upcoming and interesting area. If you are basically using a lot of customs exemptions, you have to look out and see whether these exemptions notifications would continue or not. Next slide. In the next slide, now we discuss some procedural changes. Now it is mandatory for you to file an advance bill of entry at least 1 day prior to arrival of the goods. Up till now, you could have filed it on the next day of arrival of the shipment. Further, they have also brought in an introduction of the customs common portal, pretty much in line with GSTN, and everyone is hoping it's not like GSTN, but it's a better version of GSTN. But this new portal would basically now allow and facilitate filing of bill of entries, shipping bills, etc., and more automated exchange of information would happen through this portal. Next slide. Yeah, next slide, please. Yes. Some other changes on the customs law on the refund side. Government seem to be pretty much in a fix due to these fake invoices, and now they have brought a change in the customs law also to say that in case you are using a fake invoice for taking a credit and claiming a refund on goods which are exported, the government can basically seize these goods, confiscate these goods, sell these goods, and then also apply a huge amount of penalty up to 5 times of the refund claim under the customs law also. So this is all to stop the menace of the fake invoicing under the GST regulations. Next slide. A couple of other important changes, I would say. Now it is mandatory for the customs authorities to complete their proceedings within 2 years of initiating. So you have a lot of DRI inquiries, DGCI inquiries which start and they keep on pending for endless period of time. Now it is mandatory for the authorities to issue a notice within a period of 2 years. And then there are some consequential changes in the IGCR rules. IGCR rules are used for import of goods under some exemptions or concessions. So certain regulations are required to be followed. So they have now relaxed a lot of conditions under these rules where you are allowed to do job work, send goods for job work, etc. Next slide. Yes. In the next slide, now we can see that this is a new introduction of AIDC, which is an agricultural infrastructure and development cess. This is a new cess which has been introduced typically where on some agricultural products and some other products which you can see on your slides. The point here is that when this new cess has been introduced, there has been a corresponding reduction in the basic customs duty rate, and therefore net effect of is that there is no change on the effective duty structure even on these products. And the reason why they have done it is because they basically, the central government wants to hold back more revenue and not share it with the states, because a cess basically forms part of the central kitty and it is not required to be shared with the state government. So therefore they have reduced the basic customs duty on these products and introduced a parallel cess for the development of agricultural sector. Last slide from my side, which is the next slide. Here I have just given a small table of a lot of customs rate changes which have happened. Mostly, the rates have increased. If you can see, there are many places where the rate was 10%, which has now been increased to 15%. And the goods include a lot of goods under the electrical sector, electronics sector, where DC motors and mobile parts, solar finished products, sound signaling equipments. A lot of these electronic goods, the duties have been increased, basically to promote the local manufacturing and local value addition. And at the same time, they have reduced the customs duty rates on steel products, because in the last 6 months or so, the price of steel products shot off the roof. They increased by more than 10,000 rupees per ton. So this has now happened that they have reduced the basic customs duty rate. They have also withdrawn some of the anti-dumping provisions on the steel products, whereby we could see an immediate effect on the prices of the steel products in the Indian local market. But as I said, there are a lot of changes on the basic customs duty side on products, and therefore all companies have to effectively just go and check what are the now effective rate of customs duty on the products that they import. So next slide. Yes. So now we move on to some quick words by Sunil on transfer pricing proposal.
Yes. Good afternoon. I think everybody might be wondering, if there's no amendment in transfer pricing, is there really a next slide? So there are two amendments in transfer pricing. One is for the return of income filing for the partners, and relating to MAT, where you have a secondary adjustment. I think both of them are covered by my friend Chetan. But then what is really there in transfer pricing in this session? So next slide, please. So we come to the slides now. So as it is clearly mentioned, there are absolutely no amendments proposed. So what do we really expect in this presentation now? Now, one thing is clear is that the government has a lot of spending to do in this pandemic year for social activities, for health, and other areas where they have lost a lot of GST revenue, income tax revenue. So certainly for meeting all the big claims or big allocations done in this budget for the future, where do they really want to get the money from, especially when there is absolutely no increase in GST rate, absolutely no increase in the income tax rates. So where to get this money from? So what we thought is, let us focus on some litigation points, which we thought may be looked at. No, please wait. One slide earlier, please. So although I have only 3 slides, I will take a lot of time, I hope.
But you don't have any.
Yes, I don't have time. That's what Rahul says. But so let us look at what has already been introduced in earlier budgets under the BEPS initiative of OECD, where India also contributed a lot in the OECD discussion. And you have rollouts coming out in 2017, the master filed country by country report, and all these reports which were made mandatory by the Indian companies to file, who of course have international transactions. Now these filings which are done, why were they really required? So world over, it was the need that the tax officers do not get information relating to the group, or they don't have an overview of the whole value chain, or where the profits are parked, where the intangibles are owned. So there are plenty issues which only looking at a country's taxation, you don't get to see the whole picture. So this demand was, I would like to clarify, not an Indian demand, but from the tax officers world over. So these initiatives are there. So filings have happened for last 3-4 years, and certainly now income tax departments all world over have a lot of information. And you know how this can be dangerous in, when you look at the Indian income tax authorities. Unlike some jurisdictions where, what we've heard from clients is we go and discuss with the tax authorities. This certainly does not happen, in India. Certainly a way forward is being discussed that yes, there should be some consultation or pre-consultation to avoid, unnecessary litigation. The other 2 points were thin capitalization, where interest payments on loans which are taken by the Indian companies or given to Indian subsidiaries abroad, that interest allowance should be restricted. And the last one is the secondary adjustment. So where you have a transfer pricing adjustment, that is known as the primary adjustment, and certainly this secondary adjustment, kicks in once the primary adjustment is more than 1 crore. And this certainly has happened probably for the first time in this year, when the transfer pricing orders have been issued for financial year 16-17, that is assessment year 17-18. These orders have now come out by 31st Jan 2021. So all those orders with a primary addition of more than 1 crore, you certainly have to discuss about the secondary adjustments. Now these secondary adjustments also have a role to play in what Chetan has discussed about the computation of MAT. So this is one point which we have to look for in the coming months. Next slide, please. Yeah. So now, as I said, the focus of the tax authorities would be, to look at transfer pricing policies and arrangements of multinational groups. So, is the pricing right from an Indian tax point of view? Is the focus. Silently, when COVID was prevalent in February 2020, I should not say silent. I think everybody was working from home, and therefore, outside world was silent. But OECD came out with its transfer pricing guidance on financial transactions in February 2020. Certainly, yes, India is not an OECD country, and therefore these guidelines do not apply to us directly. But however, since we don't have any guideline, you taken some guidance from these transfer pricing guidelines which are issued by the OECD. And I'm sure if you look at those financial transactions TP guidelines, the Indian income tax authorities have certainly read it, and what we see is the transfer pricing assessments which have been recently concluded in Jan 2021, just 3 days back. We've seen additions, for interest on ECB loans, guarantee fees, and not charging of interest on outstanding receivables. So this is what I would say, a new favorite of the income tax authorities, which I see in the coming years. For an example, ECB loans till now we were referring to FEMA guidelines which were issued by the Reserve Bank of India, and in those FEMA guidelines you had a range or a maximum permissible threshold of interest that you could pay on loans which you took from your parent company from outside India. So typically, if the maturity was more than 3 years, the rate of interest was LIBOR plus 4.5%. Now this is all going to change. They are going to fall back. The income tax authorities are going to look at, the financial transaction guidelines, which the OECD has come out, which is not applicable directly, but certainly they will read it and they will apply it. And we've seen that application in some of our cases. What is going to happen? If you remember in 2009, even for the intangibles, where royalty rates were, liberalized, there was a cap for domestic sales. 5% royalty was only allowed, and for exports, 8% royalty was allowed. Now this cap was there in FEMA. Till 2009, royalty was permitted. Even the income tax authorities, the transfer pricing officer, did accept whatever was there in the FEMA. But suddenly after 2009, they said no, this is for FEMA guideline. That is the cap which the RBI has given. It has different logics, but you need to compute the arm's length price. And now what we have seen in BEPS for intangibles, they have come out with a nice word of DEMPI. You have to have the jargon, you have to complicate the industry and the tax authorities, and I don't know who earns, probably only the consultants earn, and I don't know if it's really good. So DEMPI is, again, we have to decipher it. It is who's doing the development of the intangible, who's enhancing the intangible, who's maintaining the intangible, where is the protection of the intangibles, and who's exploiting the intangibles. Now this DEMPI was not enough, so Indian tax authority said, no, it is not DEMPI, it is DEMPEN. So they added one more N, which is for market. And what the Indian income tax authorities are saying, market is an important point. Okay, you manufactured in Germany or wherever in the world. Finally, it has to be sold. Only then profit will be earned. Without selling, how will you get profit? So this M, that is the market, is also an important part. So while you cannot ignore the market, is what the tax authorities in India have always said. So certainly there will be a lot of litigation on the intangibles part, the financial management fees, that is their favorite. In management fees, you have to demonstrate the actual receipt of service, the commercial need. Did you really ask for it? Did you really require it? What are the economic methodologies? What is the pricing methodology? So it is like, even if you have paid for IT services, like your servers, your Microsoft Office, your laptops under some Dell arrangement, but still they get disallowed. They say, where is the benefit? Then you have to go and, prove that you see this is the company, my number of employees. So that is the way, at the initial levels, it all gets disallowed, and you have a lot of litigation, at least in these three areas. So this is what we wanted to discuss on this part. One more thing on the OECD guideline is, they questioned whether when you receive a loan, in the transfer pricing audit report also, you have to disclose, all transactions. One transaction is receipt of loan. Now, when you receive a loan of say 100 crores, this is reported as a transaction. What is really the arm's length price of this, receipt of loan? Now, OECD says that yes, whether a loan is a loan, you have to also question. So you cannot have, equity as say 1 lakh rupees equity infusion and 100 crore as a loan. So this tussle is already discussed, probably on the first chapter of this guideline. That first of all, see if the loan is a loan. So a lot of litigation can come out of this. But to my mind, from the Indian structure, as I said, thin capitalization was already introduced. What was thin capitalization? There was restriction on the allowing of the interest amount. So on the ECB loan or whatever loans you take, you want to restrict the allowability of the interest. So you disallow the interest. And in the BEPS also, there were models discussed that, to curb this thin capitalization means you have lower equity and higher debt, or a mismatch there. So other than what, is prevalent in the specific industry. So what you have to see is whether this loan is a loan is a question mark. Now, since you have thin capitalization, you have selected not debt equity, but so India has already selected an option. So to my mind, this OECD guideline should not be negatively taken by the Indian tax authorities, at least for questioning a loan, whether it is a loan. And specifically, this probably will happen only if you invoke GAR. So where the benefit is much higher than probably 100 crores. So where you have to look at the tax benefit of 3 crores and above. So that is about GAR. So I am sure, as I mentioned, for royalty, the FEMA guidelines were ignored. Certainly for ECB loan interest also, those FEMA guidelines will just remain on paper. This clipping of Economic Times is regarding government considering reintroduction of restrictions. Rahul is making indications. My time is gone, but let me just go on. So this is regarding the Economic Times noting. This is a snippet from November 2019, where they were again considering to bring the royalty payment restrictions. Now this point is caps. Suddenly they were gone, and now suddenly they want to bring it back. So who really had thought of this idea is the Department of Promotion for Industry. And fortunately, the Finance Ministry has taken an option. No, this will send a negative signal, to investors abroad. Fantastic. So I hope this really does not see the light of the day, and we hope that royalty is really not restricted. Because in 2017 there was a survey that there was a surge in royalty payments from India to overseas. Next and last slide, please. So I make Rahul happy.
Let me now quickly that yesterday actually Sunil wanted to skip out because he said there's nothing much to say about transfer pricing, and now he took almost the longest time.
So we come to we want to touch on a very small topic for in relation to this Atmanirbhar Bharat Abhiyan. So not relating to what they have said, but what we see as the idea of the government is to increase manufacturing activity in India or to make India as a manufacturing hub. Now to do this, maybe you will have contract manufacturing activity done by an Indian company, right? So you will have manufacturers doing manufacturing activity for what SEZs are. There is you manufacture and you export, or you manufacture and sell in the domestic market. Now typically litigation here is again on the cost base. So what is the cost base, whether you take the full cost, whether you take interest also as a cost. So all these factors will take into place for both these items. However, for manufacture and export, it is fairly simple. You become a contract manufacturer, you are characterized as a routine entity, and therefore your margin needs to be as a routine manufacturer should earn, and that would be the arm's length margin. When you complicate your own activity by trying to sell part of it in India, or have total sales in India, so when you effect all the sales in India, the Indian company earns the selling price from the customer. Now typically a selling price is part component for the manufacturing activity, part is for research and development, part is for marketing, and part is for your profit. So in the first case, what is the arm's length compensation? You get all your costs for manufacturing recouped with a margin. In the second case, you also do marketing activity and you also have to earn some profit, because as I had mentioned in the earlier para where we had DEMPE as the function, now marketing is also done here, or exploitation of the intangibles is also done for the Indian market. And therefore, since it is the expectation from the German company or from the parent company worldwide, that residual profit should come to their jurisdiction, that gets controlled by doing some benchmarking analysis and determining the correct arm's length compensation when you also carry out additional functions and take more risks in India. So what the functions, asset and risk should drive your profitability is a point also needs to be noted. Probably the government also should come out with some safe harbor in this case. So that's all from my side. I think this is all what I wanted to share in the no amendment phase.
Yeah, thank you. Thank you very much, Chetan, Anand, and Sunil. I think excellent presentation. As they say, the devil lies in the details. So I think there are a lot of nitty-gritties that are there. One has to understand. And also, I would like to thank Carl for his address. I think it was very important to understand how the situation in Germany is. Anand, if you're there, I would just request you also to switch on your camera. We have exceeded time, but let's quickly take a couple of questions. There are a lot of questions that have come in. Carl, let me start with you. Carl, there are a couple of questions that have come regarding the present visa status. Could you let us know what is the present visa status? If any Indian businessman wanting to go to Germany, is he allowed to go, or there are certain restrictions?
So generally, travel is not allowed. There are exceptions for very urgent cases. So if it comes to family emergencies, or also to very important business meetings, like the business would not take place, or a very big investment would not happen if the travel can't be done. but this has to be then a Schengen visa can be application can be filed, but it really has to show why it is very urgent, the travel. So this general travel to make some to visit some business partners or to maybe make some promotions, some sales, that is not possible at the moment. And also long-term travel national visa is possible, for example, if you want to start working in Germany or studying. This is also possible at the moment.
This is possible. So that's what you said. Students and long-term work visas are possible. Okay.
And business,
I think
in emergency cases. Yeah.
Right. Thank you. Thank you, Carl. Anand, let me, or Chetan, let me start with you. Actually, there's a question regarding the equalization levy. So there was this term, does meaning of online cover placing of an order by email. Would that be also considered, Chetan?
So that's a very interesting question. And as I said in my presentation, that there are actually like a lot of clarifications were expected on equalization levy. Unfortunately, they have not come through. And so the way the word online has been defined, actually it refers to any kind of access through internet, through telecommunication or any other link. Everything is covered in online. With that logic, even email should get covered in online. So if you look at theoretically, yes, on email should get covered in online. But the way the intention is there more for online platform or some other kind of Amazon or those kind of cases. So really, like it will be a matter of debate to say like if take a position that this should not get covered, but because there are no guidelines to it. And even India had an expert committee report on equalization levy, which also did not address, unfortunately, this kind of situation.
Okay. Thank you, Chetan. Anand, let me come to you. It says that it was told that the employee's share to any fund will be disallowed if not paid in due date. So the question which arises, is there no option to pay employer and employee share separately? Then how is this provision going to help the assessee? I don't know if it's clear, Anand.
So it is actually a question for me, right, Anand? Should I take it?
Yeah, this
Can you take this?
Yeah, okay. So basically, this is regarding employee PF contribution that we talked about. So in case of employer PF contribution, as I mentioned, there is a longer time available to deposit the contribution and still you can claim a deduction.
And you are muted. If you can unmute yourself.
Hello.
Yeah, continue.
Yeah. So yeah, right. So this is regarding a PF contribution. So employer PF contribution can be deposited till a longer time frame, which is up to the date of filing, and it is allowed. But in case of employee PF contribution, the deadline is really as per the PF law, which is 15th of next month. And so the question has arisen that okay, if I cannot make a separate payment for the two contributions, how these projects are operating differently. But I think that is how the law is worded, and probably partial payments, etc., are allowed. So it may happen that if you are making a payment partially and it is towards employee contribution, that may still get allowed, and employer contribution you may, if you are paying subsequently, that may also get allowed. So I think so. These are really I mean, there is no linkage from income tax perspective for these deadlines. So they are kind of independent rules.
Okay, then one more, I think it's more a general, I don't know who can take this up. Could the budget have done more for the Aam Aadmi?
I think one good thing is there is no COVID cess. You don't have a COVID cess surcharge or some, additional tax. So that is the best thing I would say.
Okay, so I think we have to, that there is no COVID levy or COVID surcharge levy. That is, I think, the part to be happy about then. Okay. And I had one question regarding the fee actually. We've seen a lot of these farm protests in the last 2 to 3 months. So would the budget in any way help to soothe the nerves of the agri sector?
See, from my perspective, the way I see it, frankly, is these are two topics which are largely unconnected from a perspective of regulating the sector itself. While the government has been increasingly, spending more on MSPs and on agri produce through FCIs, and it was a very interesting topic this year. If you look at closely the budget numbers, they have earlier the loan that they used to take. They used to take on the FCI books. Now they have taken the opportunity to bring that loan of FCI into the books of the government itself, thereby settling the old dispute as it was. So from a budget perspective, they have done well from allocation perspective and settling this problem of taking loans under FCI. But the law itself, which is currently being debated by the farmers, is not connected as such with the budget. They could actually, they have already done what they could have done in budget. I believe it is my personal view.
Okay. Carl, actually, there's a question that has come. This is regarding German travel to India. Are Indian, do you know, Carl, if Germans are allowed to travel to India presently, or there are restrictions, or can, because I think there are some cases where the service people have to come for some commissioning, assembly and commissioning. So I don't know, do you have any updates here, Carl?
Yeah, there are no restrictions from the German sides for Germans to travel abroad. It's just that they have to go into quarantine for 10 days and can shortcut the quarantine once they come back to Germany after 5 days with a negative corona test. But it is more a question of the Indian government allowing that, and I'm not sure about this. I mean, I know that tourism is still not possible in India, so Germans can't come for that. About important business visa, I'm not really sure. I was on Aero India yesterday, and I saw a lot of foreigners being there. So I mean, I don't think they all work in India. They all look like exhibitors who were traveling from all over the world to India for Aero India. So I think that there should be a possibility, but this is a question I cannot answer it. It's the Indian around the world, or the Ministry of Affairs of India has to answer this question.
If I may answer, as far as I know, it is possible, but you have to be 7 days in quarantine, and which makes it not for many business traveler not feasible. So you have to be minimum 7 days in quarantine.
Right. I think maybe
it also depends on the state. I think different union states have different rules for travelers. So it really depends on where they want to go.
Yeah, could be.
Right. Yes, I think Maharashtra specifically has that 7-day quarantine. Some of the other states, I think, are more liberal on that issue, that if you come with a negative, I think 4 states totally have this 7-day quarantine. Maybe the last question I would like to take is, I'll leave it to the Rödl partner team who would take this. Would there be an impact on allowability of delay payment of EPF for prior years under litigation, considering the clarification applies prospectively?
Yes, so I'll take it up. Basically, like I think this is a very good question, that the amendment is the way it has come as a clarification, that it was always intended in a manner that payment beyond due date should not be allowed. Whereas the applicability is now from next year. So what happens with the prior years? So there have been similar situations. So this is not the first situation. There have been similar amendments in past also, where they were intended to clarify the intention of the government, but they were applied from a particular year. And in those cases, again, there has been a litigation, and some cases have favored the taxpayer, that since the amendment had come from a particular date, it should apply from that date, although it is said that it was always intended in a particular manner. So since there is no specific retrospective mention, so those cases can be taken as a supporting argument in these litigative cases.
Okay. Yeah. Yeah, I think we'll have to close it now. I'll hand it over to Rahul for the concluding address. Rahul, over to you, please.
Yeah, pleasure. I think it is the fifth budget session which we are doing with VDMA, and it was at least this time surely only positive news. From a investor's perspective, and that's something which we should convey to our shareholders in Germany. Yes, India is a stable country. Yes, India is committed to be an export nation. India is rolling out the master plan very well to be a global part in a global supply chain. Carl mentioned last year that there's a big requirement of the free trade agreements. Yes, this will remain as a very important. I did not forget it, and I'm as well in favor of it. But yes, Carl, we should address that constantly. Probably India will hear, and probably EU will hear it one day soon. What I'm very happy about is the question of the heavy investment in infrastructure. All these years, it was always criticized that the Indian government growth is not sustainable because there is not enough growth in infrastructure. Now, despite of Rajesh not being in the panel, I will take a statistic, which is now 26% of growth in infrastructure, comparatively to the high benchmark already from last year. This is a phenomenal growth in the infrastructure, and which is really a sign and a long perspective of a good growth of India in their economic perspective. And I really appreciate that. I think no one could have ever expected more tax deductions. It is a very intelligent budget by privatizations. I think Carl can appreciate as well that we had in Germany a substantial reduction of state-owned enterprises. Some of the people are still cribbing about it as the telecommunication charges went up, postal charges went up, everything went up. But the government is never a good entrepreneur. So leave it to the entrepreneurs. I think it will be a good opportunity. Interestingly, they have as well further motivated FDI in insurance policies. I think they are planning to sell LIC stakes to some foreign parties. Could be interesting. Overall, let's be positive. We have all in our Corona days again. Let's be optimistic, not positive. And we are on the right path. We are on a good path, and India can sustain with such policies. Thank you very much. And the last 55 people who stayed back till the end, thank you very much.
Great. So thank you, Rahul. Thank you, Anand, Chetan, and Sunil, and Carl also for joining us today. And thank you, Rödl Partner, for joining with VDMA for this important webinar. And to all our participants, we had a good number of participants who had joined for this webinar. So thank you, everyone. And I think, as Rahul mentioned, it's a progressive budget, perhaps a budget with a foresight, with a concrete plan. And let's hope this budget really gives India the push needed to reboot itself after the slowdown what we have seen in 2020. All the best, friends. Stay safe, stay well. Thank you very much, and goodbye.
Thank you.
Bye, everyone.
Goodbye. Thank you.
Bye.
Thank you.
Yeah, thank you. Bye.